Good morning. I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets. Let's get started with a follow-up to part one of our Raising Interest Rates series recorded on October 11th of 2022, titled, When is the Fed Likely to Stop Raising Rates? Good news is that you do not have to watch part one to get value out of this webinar because I've copied the original charts into this week's webinar for full context. If you would like to watch part one of the Raising Interest Rates series, you can find it in our research lab on our website at www.pacificpoint.net. Simply access the webinars section of our research lab. You can also go directly to YouTube and search Pacific Point. You can see both locations in the images on the left. Simply look for the title, When is the Fed Likely to Stop Raising Rates? As we mentioned in the October webinar, historically speaking, the ISM Manufacturing Index has been one of the most reliable indicators for Fed policy changes. ISM Manufacturing and Service indices have tracked one another fairly closely, and they speak to its reliability as an indicator for Fed policy changes. Note the depth of some of the contractions during recessionary periods. Recessionary periods are noted with gray shaded areas in the current and all subsequent charts you will see in this webinar. The September read came in at 50.9 versus a forecast of 52.2. October was only a 20 bip surprise coming in at 50.2, and November was a miss at 49 versus a forecast of 49.8, pushing the manufacturing sector deeper into contraction. And you can see I have that red horizontal line here marking the difference between expansion, anything over 50, and contraction, anything below 50. Please note that in the current and subsequent charts, you will see September versus November reads called out in chart captions with red font. So this chart is updated as of November of 2022. This is the chart that was present in the October webinar, updated with data as of September 2022. Back in October, we stressed the importance of establishing a baseline for manufacturing versus services contribution to U.S. economic activity. And for this, we mentioned that we prefer GVA versus GDP given the inflationary environment we are in. Note that GDP, or gross domestic product of a country, is the final value of goods and services, while GVA, or gross value added, is a metric capturing the same value but subtracts input costs. Recall that we prefer GVA as a measure for sector contribution because it neutralizes the effect of inflation and allows for a more accurate cross-sector comparison. Observing manufacturing as a percent of GVA, the manufacturing sector has fallen to only 11.7% of U.S. economic activity in November. This from 12.2% in September when we originally reported this in our October webinar. In the following chart, you can see the services sector as a percent of GVA has risen further to 80.3% of U.S. economic activity in November from 79.6% in September. And you'll also notice they actually had to change the frequency of my reporting to monthly as I moved off of calendar aligned quarters. So the November period monthly to get the data to display versus the ability to use quarterly periods that appear a little smoother since September falls on a quarter alignment. Look no further than these Wall Street Journal articles to find the importance of the services sector when it comes to both job creation and wage growth. The following articles typically appear the day after the monthly job numbers are reported. The image on the left is the September 2022 jobs report article we discussed in our October webinar, and the image on the right is the November jobs report article present in this past weekend's edition of the Wall Street Journal. Note the red circles in both articles, and despite growth slowing from the first half of the year, employers added 263,000 jobs in both the September and November periods. This rate is well in excess of pre-pandemic levels and continues to drive wage growth and inflation. Digging deeper into both articles, you can see that labor market gains continue to be almost exclusively services driven. This is not surprising given that the services sector has actually increased to 80.3% of U.S. economic activity. And you can see here from our October webinar some of the notation, some of the higher contributing industries I've compared those to the November report. And if you look at this closely, you can see that just the bulk of these labor market gains have been driven by the services sector. As we mentioned in October, economists and financial experts are effectively dismissing the dysfunction in the labor market as a lagging indicator. It is true, it is a lagging indicator, but sadly, conditions have not improved much at all due to the continued strength of that services sector, which is one reason the Fed continues to keep their foot on the gas with rate hikes. The chart in the upper left represents the September 2022 levels from our October webinar, and the chart on the lower right represents the November 2022 levels. Inflation, represented by CPI all items in blue, continues to exceed wage growth, represented by average hourly earnings in green. Note that average hourly earnings actually ticked up in November, and you can see that here for that 5.09 versus the September read of actually 4.98. The labor market dysfunction is being compounded by labor force participation and labor productivity, both of which remain well below pre-pandemic levels. Back in our October webinar, we attributed the bulk of the inflationary pressures to the services sector and illustrated the relationship by comparing ISM services sector growth versus ISM manufacturing sector growth. The chart on the upper left illustrates the September ISM manufacturing index, representing roughly 12% of U.S. economic activity, was nearing contraction at 50.9. You can see that here. While the services sector, representing roughly 80% of U.S. economic activity, actually remained high at 56.7. So you can see that massive disconnect here. Fast forward to the November ISM reads in the chart on the lower right, the manufacturing index has now slipped into contraction at 49, while the services sector remains stubbornly high at 56.5. And you can see that in October, we actually dipped a little bit, but then in November, we shot right back up to September's level. The stickiness and subsequent focal point of services activity is something that we predicted in our October webinar. Back in October, we spoke to the chart on the upper left and commented on the red circles, stating the ISM Manufacturing Index and U.S. Conference Board leading economic indicators can fall further before the U.S. enters recession. We further stated to keep an eye on the ISM Services Index because the Federal Reserve is likely to continue raising rates to tame the services sector while driving the manufacturing sector deeper into contraction. This relationship was noted with the green and blue arrows, and you can see that here. Okay, this is what we had predicted. Roll forward to the November chart on the lower right, and you will see that both ISM manufacturing and leading economic indicators in contraction, while the services sector remains stubbornly high despite the Fed's ongoing efforts to cool U.S. economic activity. So this uptick here in services actually surprised us as well. And remember that this services level of activity needs to come down, and in the process of that, it's going to continue to drag this ISM manufacturing activity level further into contraction. So clearly, the Fed has more work to do, and the manufacturing sector is likely to fall deeper into contraction. This is the chart from our October webinar that sums it all up. It's been refreshed with all the latest data points. In the bottom panel, note the red circles that illustrate periods of positive real Fed funds rates, where policy rate is in excess of PCE Core rate of inflation, necessary to keep inflation in check. Note that in the most recent period, the Fed is still struggling with negative real Fed funds rates, meaning that the Fed cannot even consider stopping rate hikes until inflation, noted by the red arrow, crosses below the Fed funds rate, noted by the blue arrow, creating positive real policy rate, which is necessary to drive inflation back to the Fed target of 2%. Statements made by Fed Chair Powell have paved the way for a downshift in the future pace of rate hikes, but also made it clear that the Fed has a ways to go to tighten policy and will likely end up with a higher terminal rate than originally planned. We feel that the Fed's rate hikes are appropriate to tame the services sector, the labor market, and subsequent wage growth, but in the process will drive the manufacturing sector deep into contraction, significantly raising the risk of recession in 2023. So until we see positive real Fed funds rates, the Federal Reserve is likely to continue raising interest rates. That's about it for today's session. Please be sure to join us next time when we dive into the consumer savings rates coupled with the rise in revolving and total credit to see how inflation has become a threat to consumer spending going into 2023. Thank you all for attending.